for a very, very good delta. What is a good delta? Well, here's the January 05 options. The option that came up on our search or on our list there was the $15 option. Well, again, $15 option. Let's scroll over here. Take a look. That means that the option, the last trade was $9.40. The theoretical value of the option is $10.04. Pretty darn good. That's real close to the actual price, okay? In fact, the actual price of the option is underneath. See, the last trade is $9.40, and the theoretical value, that means it's actually undervalued. We go right over here, and it says the delta, let's see if we can highlight that. There we go. The delta is 97. Wow. Which means the stock moves $1 and my option moves 97 cents. Wow. Therefore, using this as a proxy or as a percentage or as a derivative or a derivative investing, basically we used to call that, is a fantastic tool. So let's see. The stock is at $24.73. So if you were to buy, let's say 100 shares, that would cost you what? About, let's just use round number, about $2,500? Is that about right? 25, so approximately $2,500. You don't have to sell it ever. It's a stock. You don't have to sell it ever. In this circumstance, we could buy the leap option that controls the stock at $15. Well, the bid on the option is $9.80. The ask on the option is $9.90. Well, we would probably buy it at the ask at $9.90. Remember, each option controls 100 shares. We already know that. Move the decimal place over twice. That means we're going to spend $990. We control the stock for $15 a share at $9.90, and it moves at a rate of 97 cents for every dollar move. I hope that's good enough, because that's a great movement. We can use these leaps as a substitute for stock. Conservative is buy in the money, which means we buy several strikes, usually 2 strike prices below the actual value of the stock. Aggressive, you can buy at the money or out of the money, but that is aggressive. Please do not start with that. I would in fact discourage you to start with that. I'm going to encourage you to play in the money options. Look for delta of 90 or higher. If you're following along with your workbooks at home, go ahead and circle 90%, 90 or higher, okay? That's ideally what we're looking for. We set a stop loss of 30% of the purchase price. Non-emotional, remember, we're non-emotional about this part, okay? 30%, we're gone. We're done, we're wrong, all right? Next, evaluate your leap 6 months prior to expiration. Now, let me use my analogy. We're buying an option, an ice cube. We know that it's going to expire. We're going to buy it, a year, maybe 2 years away, okay? Let's just say it's a year away for this example, okay? So we're buying an option that has a year to expiration. Now, this is why we evaluate our leap options 6 months prior to expiration. We're going to go ahead, we own the stock, we own the leap, stock's doing well, but it's expiring, it's decaying, it's a decaying asset. Now, all of a sudden, it's, 8 months left. All right, fine. It's decaying, it's decaying. Now it's 7 months left. Now it's 6 months left. Watch. Is that option, especially if the stock's not moving, the decay of that option will look like this. The first from 12 months to 6 months, it looks like this. Not that big of a deal. I mean, it's decaying, not that big of a deal. Then all of a sudden, once we hit 6 months, the decay of the option looks like this. Okay? It accelerates very, very aggressively. So remember, if we're buying an option, decay or the time is not our friend. Consequently, we would need to go ahead and be cognizant of the fact that the decay, or what's called the theta, as you progress in your advanced option, the theta of the option or the decay of the option accelerates as you move closer to expiration. From 6 months on. Why is a leap more aggressive investment than an outright stock purchase? For the simple reason that I explained, you're buying a wasting asset versus a hard asset similar to a stock. And you get the leverage of margin without paying margin interest. Many of you already know about margin, but you go ahead and give your broker $5,000 and they'll give you the ability to buy $10,000 on margin. They'll charge you a margin interest, whatever your broker will charge, maybe 6, 7, 8, 9%, maybe 7, 8% is about average, and that's the cost of money. Now that said, that's fine. Some of you folks that maybe get a little bit better at day trading, you can even get excessive margin on day trading, all right? I sometimes do day trading because even to this day, if I see a $1,000 bill lying on the floor, I bend down and pick it up, okay? I only do day trades if they're really clear and very easy, if you will, to make money. I see that the overall trend of the market's up, I may go ahead and do a quick day trade. All right, I don't specialize in it, but I already have the skill set to make money that I'm teaching you right here. And sometimes if that time frame is compressed, those 3 green arrows happen now, the heavy volume's happening now, sometimes I'll go in there and do that. But remember, I'm full-time, okay? If you're interested, maybe we'll talk more about that, maybe in other courses. We don't have any right now, but we're noticing people are more interested in the markets, which makes a whole lot of sense. So now, before we move on, let me go over here to what would happen and what is your cost basis of this. Well, we see that the stock is about 25 or 20, excuse me, exactly, it's 24.73. And the option, let's go over here, let me use my mouse, let's go over here. The option is $9.90. Well, let's do the math. That means, everybody run with me here, okay? Let's think. We're going to spend $9.90 to control the stock at 15. Do me a favor and add that up. Is that about $24.90? Is that about right? Is my math right? I hope so. Because that means our cost basis basically on the stock is $24.90. Just think logically. I'm spending $9.90 to control it at 15. That means, add them up, that's $24.90. So make sure this makes sense, as soon as that stock crosses $24.90, which is within about a quarter, or whatever it is, 20 cents, is then your delta will go to a 1-to-1. All right? So as soon as you pass that threshold, now we've got a 1-to-1 movement. We are good to go. All right? So just exciting things that are happening. So could you guess the prospects over 6 months or 8 months? Sure. Don't worry about an option that expires in 1, 2, or 3 months. Put down maybe a couple extra dollars and control it for a year and a half. As long as your delta is appropriate, your rate of change, the stock moves, your option moves 90 cents, it's a fantastic trade. Now that said, I am encouraging you again. You saw me if you watch the DVDs, I'm very passionate about paper trading. Our new paper, it's brand new by the way, so the alumni that are watching this that didn't have access to this a while ago, our new paper trading suite or part of our website is fantastic. How do you get good at this? Is you make more paper trades, okay? Use it extensively, aggressively, overuse it, burn it out, buy a new computer. I don't know. I want you folks paper trading aggressively as much as you can because you win. As far as your experience, you get better. Your experience gets better from your wins and your losses. And in fact, I submit to you is that you actually do better from your losses. Your wins, how do you improve on a win? What do? I wish I woulda, coulda, shoulda. On a loss, you can say, oh, no, I was wrong. I bought wrong. I did this wrong. I didn't follow the 8 steps or whatever, okay? So that's where the leaps can really, really benefit us, okay? Now, in your books, when we're going to go into stock splits, please understand that these are aggressive. Let me say that again. They are aggressive, okay? Not as popular as when I first started doing stock splits. Let me give you a little background. When I first started doing stock splits, we would actually have what are called stock split pagers. They were either Bloomberg or Dun & Bradstreet would provide those for us, and as soon as the news came out, you get a bunch of news on them, but as soon as a stock split would come out, whammo, you'd get a page, and then you'd go buy the stock. And it could be very, very good if you were very quick. That no longer is the case. Humorously, I remember the first time I got my pager. I kind of grew up, middle America, whatever, and I first got a pager, and there was only 2 people that had pagers when I grew up. First of all, usually it would be in a restaurant, the gentleman would get a page, beep, 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 right? They would get up and go do brain surgery and go deliver a baby or something. That's how I grew up. And then there was only one other person that had a pager. So when I got my pager, I remember my mother, I love my mother, she's a wonderful lady, one of my best friends, she put her head in her hands and said, my son is a drug dealer, and said, no, Mom, it's a stock split pager. I'm trying to keep in touch with the financial markets, okay? So that's what we did to go ahead and keep in touch, okay? That's no longer a valid, we don't really have those. I don't even know if they're available. I don't think so. Don't quote me on that. But stock splits, let me show you on how we play them a little bit more conservatively. Back in those days, it was very volatile. Now, I just think it's kind of an armchair quarterback way to play these and still make excessive returns on them. Great rate of return. There's 5 key points to a stock split. 5 key points to a stock split. Now, and when we learn about stock splits, okay, I'm going to encourage you to go ahead and learn this strategy. This is covered by your coaches. It's a very, very excellent way to make money. There's several different types. Let me back up and say there's several different types of stock splits. First of all, and the most popular, is what's called a 2-for-1 stock split. And that said, you get 2 shares for every 1. Those of you who are new to investing, kind of let me give you the analogy. You own 1 share at 100, then it splits. You now have 2 shares of a 50. That's about it, okay? Has your value changed in that example? No, sir. No, sirree, Bob. It certainly did not, okay? So that is what we call a stock split. Now that said, since we have I've got some converts here, I think, over in the option camp. Think about what happens to an option. The option splits as well, all right? Now, borrow from this little story here from me, okay? Let's take a look at what happened to me several years ago. Dell Computer had done something that nobody else had ever done before. They were splitting their stock excessively. In fact, it was twice a year for 3 years. And what happened, they became so big, they didn't really split their stock anymore, and pricing pressures, et cetera, et cetera. In fact, I love Dell Computer. I don't know about you folks. I think it was a great stock, a great company, and I got in. Don't quote me on this either, but man, they were selling like $8 million a day over the internet or something like that. I don't remember. That sounds like a great business model to me. How about you? When there's no overhead, there's no retail stores or leases to worry about. I thought that was brilliant. Well, my mentor said, hey, you got to get involved with Dell Computer. And I said, fine. So I looked at it. It was very expensive at the time for me, but I still went ahead, went on a limb, bought 10 contracts. I think I picked up a few more than those, but let me just do this analogy in front of you so I get the math right. We had 10 contracts of the 30s. They had 6 splits, and I wasn't that good to get all 6, but I was good enough to get 3, all right? So let's watch what happens when we combine these strategies, okay? Now keep in mind, I didn't have a whole lot of money back then. I spent a lot of money on my education. That was a very good investment for me. But I didn't have a BMW or I didn't have a law degree or anything like this. But I studied the financial markets. I thought, if you learn something, or what is the phraseology? If you do what you love, you never have to work a day in your life. Remember that? So I learned how to now make money off my money, and now I get a chance to make sure you folks at home do the same thing. All right? So now take a look. We have 10 contracts of the 30s. And class, everybody, let me get a little participation here for you and see if you can do the math as fast as I can. Here we go. On 10 contracts of the 30s, when it split, the 10 contracts became 20, and the 30 then split to what? 15s, right? All right, fine, not bad. Did it again. The 20 then became 40, and the 15s then split to what? 7.5. I was a bit nervous. Stock was still rising. Money flow was still good. So sure enough, I got the 3rd split. Now, I didn't get 6 of them. I only got 3. I wasn't that good. So then from 40 contracts, it then split. Then I had 80 contracts. Not of the 750s, but of the what? That's called fractions, okay? That's fine. It's late in the day. I'm sorry for that one. That was a curveball there, okay? All right, so exactly, 375s, okay? So this gentleman who I don't have an MBA or a PhD or back then I didn't even have a BMW, okay? I controlled 8,000 shares of Dell Computer at a cost basis of $3.75. And then it went back up. Was that pretty fun? I remember when I went to sell it, I had a desktop back then. I went to sell my Dell computer on my Dell computer, and literally the keyboard started to move. Not really. I think it was actually my hands because I was very, very nervous at the time, but it was a fantastic trade. Using leverage combined with this next key point here of stock splits, put steroids on my rate of return in my account. Never look back since. And I encourage you to get as educated as you can, continue your education, and learn how this stuff works. Well, let's give you the 5 key points of a stock split. Number 1, it says before the announcement. Before the announcement is a great point to go ahead and get involved. In fact, I would probably encourage you that's probably the best point, all right? That's just personal. Before the announcement. Right after the announcement, that's very difficult to get involved right after the announcement. Between the announcement date and the split date, that's possible. A little bit more difficult, but it's possible. Then, just prior to the split date, the company already has a predefined date that they're going to split at. So you can go ahead and get involved just prior to that split date. And finally, after the post-split depression. That sounds a bit unique to call it a post-split depression, but that's what it's called. I took a class on this for 8 hours, ladies and gentlemen. It is not that hard, okay? These 5 key points, we're going to highlight these. They're going to be in your workbooks. Let's take a look. Number 1, where we have a rise up, a little bullish action on the stock because we suspect that there's going to be an announcement. Upon the announcement, remember, stock splits are generally bullish. Why would a company split its stock? Well, several reasons. One, they can. Some companies can't. They're too big. But the classic reason that they say, for example, recently, we participated in a stock split. I don't recommend anything, but I showed my class this trade, We went ahead and pulled it up in front of class, and it was about $130 a share at the time, and they didn't have a 2-for-1. They had a 3-for-1. That's much better, all right? 2-for-1's good, 3-for-1's better. The next most popular split is the 3-for-2. That's okay. A 5-for-4, don't waste your time, all right? So a 2-for-1, 3-for-1, 4-for-1, that's fantastic. 2-for-1, 3-for-1, 3-for-2, those are the most common, all right? If you ever get a stock to do a reverse split, my 2.5-year-old boy, he would call that yucky, okay? That's not good, all right? That's when the stock is at a certain price, and because of whatever reason, maybe they've even become delisted, they need to pump up their stock price. So what do? They do what's called a reverse split. So in that case, let's say you have 10 shares, and it's at $2 a share. They might do a 1-for-10. In that case, you now have 1 share for every 10 that you held. That's called a reverse split. What they do is they do that to pump up their stock price and hopefully get relisted again. And if they get relisted again, then they attract the institutional money. Okay, it's called a reverse split. Let's go back to our analogy right over here. We see that the stock will rise usually up until the point where there is an announcement. On the announcement, we'll usually see euphoria come in. We'll usually see the stock maybe bounce up a little bit. This is common, all right? Common to see euphoria come in. The stock is then bid up. Now, so you know what's happening is institutions are now kind of selling into that strength, all right? Because the ma and pa investors, they get in. And institutions are kind of selling into that strength. They're not buying that, they're selling that. So if the money and institutions are called, even the more intelligent, when more intelligent money goes into the hands of the less intelligent, they can fund us. And then when the institutions stop buying, what happens to the price of the stock? It usually goes down. So take a look at this. We see that the announcement is there, the stock rises up, and since institutions sometimes will sell the announcement, that euphoria sets in. That's another entry point for a downward move. All right, so the company will go ahead and have some euphoria. They'll go ahead and retrace that euphoria a little bit, and then we're kind of back to baseline. Okay, we're usually higher than the announcement. As you'll see in this case, let me use my mouse. The announcement was right here, euphoria, and back down. Now, let me go ahead and use this analogy to help kind of solidify the points of implied volatility.